Today we're diving into Lam Research, a major player and currently ranked third in the semiconductor equipment and materials industry. We already covered the top two as well as KLA Corporation, and today the spotlight is on Lam Research. In this video we'll break down company financials, a price range by 3 different methods that could help you decide if it's worth a deeper look, and I'll also show you my personal buy price. Just a reminder, this isn't a financial advice, just my own research and my own perspective. Let's kick things off with what Lam does. Lam Research provides advanced tools for deposition, etching, and cleaning. All essential steps in creating the microchips that power everything from smartphones to AI servers. Their customer base includes leading semiconductor memory, foundry, and integrated device manufacturers. Let's begin our analysis by looking at past performance, starting with revenue, which on average from 2010 to today grew at almost 15% on annual basis. Lam Research experienced only 3 years of negative growth. Gross profit margins are expanding and they hit a record of 47.3% in last year, as well as net profit margins that are hovering at around 25 or 26% for the last 4 years. EBITDA is also expanding and is hovering at around 32% in the last 4 years. Cash flow from operations, on the other hand, is a little bit more volatile, but is also expanding if we look from the long-term perspective. Another very important metric is cash flow from operation in relationship to EBITDA, which on average cash flow from operation is 83.8% lower than EBITDA. And if we look at our graph, which is very important, EBITDA and cash flow are moving in the right direction. Because if EBITDA would outpace cash flow from operation, then we might have a little issue in trusting the financials we are looking at. Okay, but moving on to CAPEX. Here we see a little bit different story compared to ASML and other competitors in this space, as CAPEX for Lam Research is actually taking smaller chunks of revenue in the last years than it did, let's say, 15 years ago. Moving on to free cash flow, which is calculated from CAPEX and cash flow from operation, is this also expanding, and it moves very similarly to cash flow from operations. Moving on to shares outstanding, here we can see that in the past they were actually diluting shareholders. A notable jump in shares outstanding was in 2013, while from 2018 onwards they are decreasing the numbers of shares. But unfortunately, over the long term, there is still a little bit of dilution. Moving on to dividends, they first pay them in 2015 and they experience quite a sharp jump at first, and they are also growing them double digits in the last few years as well. On average, they are growing them at 27%. Dividend payout is very healthy and currently is sitting at around 26.6%, while dividends per share are also increasing, and here we also get a benefit from shares outstanding reduction. So if we take dividends per share, then dividends are increasing at 31.5%. Great financials so far, but the most important is coming up next, as we will look at free cash flow from primary business. And what this tells us is actually how profitable is a company if we strip away everything but its core business. And this is very important that it is positive. To get this number, we take net income, depreciation and amortization, and deferred income taxes. We sum them together, and from the given numbers, we then subtract CAPEX and common and preferred dividends to get our free cash flow. And for this company, for the last 4 years, it is positive, which is splendid, and on average is at 3 billion. And from this number, we can already calculate our first stock price. And to do that, we simply multiply the given average with 20 and divide it with the shares outstanding to get $46. Well, this is quite below the current stock price, so we'll move on to our next two valuations to see how this stacks up. But remember, this takes into account only the cash company is generating from its primary business. So in theory, they should not be worth anything less than this amount. Okay, to get our next two valuations, we'll need to project some numbers. And to do that, we start with revenue with our three projections. Our minimal projection is set at 0, as this will be our baseline to see how much is company worth if it stops growing. Our average is set at 9%, which is at last 6 years average, and high set at 14%, which is just below long-term average. Net income based on historical numbers is set at 22, 24 and 26%, while EBITDA also based on historical numbers is set at 28, 31 and 34%. Cash flow operation is calculated based on its relationship to EBITDA, and we get these numbers over here, while CAPEX we take a little bit higher number at 3% just to be on a safe side. We then do the same as we did previously to calculate free cash flow, and here we now also calculate terminal value. Here you can also observe analysts' numbers, what they are expecting free cash flow will hit. Now before we calculate our stock price, we need to discount these numbers back to today, and our discount factor is set at 9.2%, and with discount applied we get these numbers over here. We can now move on to our first valuation, which is perpetual growth rate. Our present value is just a sum of all free cash flows and terminal value. Now to get our adjusted present value, we take the present value and subtract out debt and add in cash to get these numbers over here and divide with shares outstanding. Then we get our stock price range, which ranges from 36 on a low side all the way to 65 on a high side, with analyst numbers coming in at $63. Our second valuation is EBITDA multiple, and here we have two multiples. One is for the industry average and one is for the company average. Now to get our price, we take 2027 EBITDA numbers and we multiply it with the given multiple, and this gives us these terminal values over here. We again need to discount these terminal values back to today. We then add in cash and subtract out debt to get our current stock prices, which for the company average ranges from $46 all the way to $82, and for the industry average it ranges from $51.5 all the way to $92, with analysts coming in at 78 and 87. Now moving on, we can average perpetual growth rate, which is a little bit more conservative, and EBITDA multiple, which is a little bit more optimistic. And with that we get our company average range from $41 all the way to $74, and with industry average coming in at $44 all the way to $78 or almost $79, with analyst numbers coming in at 71 and 75. Now before I give you my buy price, let's look why Lam Research is a company to dig deeper. Revenue growth over the past year is almost at 15%, which is very good growth. EBITDA and cash flow from operation growth matches, so there is less risk for financial mismanagement. Last debt and average debt is less than 3 times. EBITDA currently is hovering at around 1.13 and on average is 1.22, which is very healthy. One negative is that shares outstanding are not going down over the long term, even though they are decreasing shares outstanding in the last few years. And very important point is that the free cash flow from primary business is positive. This one is very important. For bonus they have a dividend which is stable and it is growing very nicely. Now based on all of this, I put my buy price at $50, which puts the trailing 12-month PE at 16.30. So where you buy Lam Research depends on how you perceive the stock. If you believe that Lam Research will continue to expand and will get closer to the industry peers in terms of multiple and because of the multiple expansion, then these numbers over here are for you. Now just to put things clear, these numbers over here mean that the company won't grow at all, and if they just are hitting those high numbers that they were hitting in the past, then $50 is no-brainer and we should buy it at that price. If they will experience some growth and they will maintain those high margins, then actually we are very close to a buying price right now, as our highest industry average is at $69, while Lam Research is currently trading at around 71.5. And if you believe in the highest numbers, so that they will expand even more than they did in the last, let's say, 15 years, then Lam Research is a buy right now. I will rather be a little bit more conservative. I already own Applied Materials, so I don't necessarily need another stock from the semiconductor equipment and materials industry. So that's why I also put buying price a little bit further down, just to be on a more safe side in case a downturn comes, as this is a cyclical market. But do let me know what you think will happen with this company and what buy price you think is the right price for this beautiful business. If you are interested in exploring other stocks, I recommend looking at Applied Materials or SML to see which company from semiconductor equipment materials industry is a better buy for you. Thank you so much for watching, and I'll see you in the next video. Bye bye!